Hello, I'm Anastasia Amoroso, and this is Beyond 60/40. Today, I'm joined by David Stubbs, Managing Director and Investment Strategy Lead at Blackstone Private Wealth Solutions, and he shares the firm's main investment themes for 2025. Then I sit down with Anthony Polemis, iCapital Head of Architect Business Development, and he explains how technology is streamlining access to alternative investments. And as always, I share the one thing that caught my attention this week in private markets. In today's private market pulse snapshot, the one thing I'm focused on is this: what the iCapital fourth quarter 2024 flow of funds data is telling us about investor activity within alternatives, and specifically in the private wealth channel. Looking at the numbers, the key takeaway is clear. Demand for alternatives remains strong, although allocations within each asset class are shifting. But broadly speaking, over the past few quarters, we've seen sustained appetite for private credit, a pickup in private equity, and continued growing interest in infrastructure funds. And notably, by the way, hedge funds had a record spike in interest in the fourth quarter. So let's take a bit of a closer look at these numbers. First, private equity. It still represents the largest share of our platform assets at 39%, and we have seen an uptick in demand over the past few quarters. And while it captured a smaller share of the overall flows in the fourth quarter in particular, capturing about 30% of the overall flows, investors clearly continue to commit capital to this sub-asset class. So why is this? Well, we think a few factors are at play. First of all, the U.S. economy continues to be on solid footing. And second, this combination of modest interest rate relief, potential deregulation, all of that improves the outlook for capital market activity and bodes well for private equity. Private credit allocations continue to climb higher. Private credit made up 35% of the overall flows in the fourth quarter and 38% in all of 2024. What's notable, though, is that private credit share of our total platform assets has nearly doubled since 2020, jumping from 17% to now over 30% today. Now, within private credit, direct lending strategies, which continue to offer yields of around 10 or 11%, they remain dominant. But we did see the appetite for distressed and opportunistic strategies soften slightly versus last year. The bigger picture, though, is still the same. Banks are still cautious on lending, and direct lending and other private credit strategies continue to fill the gap, providing attractive risk-adjusted returns for investors. Third, let's take a look at real assets. Here, investor preferences have been changing. Commercial real estate remains the largest component within real assets, but infrastructure demand is growing and growing fast. Indeed, 35% of real asset flows went into infrastructure funds in 2024. That is up from 20% in 2023 and is up from just 8% in 2022. So this shift makes sense because you have these secular growth drivers of infrastructure that are at play, like the need for upgrades, the global energy transition, and the rise of AI and data centers. And that is on top of this history of strong risk-adjusted and inflation-protected return profile. All of that is appealing to investors. Now, unlike infrastructure, real assets share of inflows has declined, falling from 92% of real asset inflows in 2022 to 63% last year. However, we think this trend could start reversing in the coming quarters. And in fact, we've recently upgraded our core real estate outlook from neutral to positive in our latest private markets and hedge fund strategy ratings, because we think the worst of property value declines may now be behind us and prices of commercial real estate may inflect higher in the coming quarters. And finally, fourth, let's take a look at hedge funds. Hedge funds saw a significant spike in their share of flows in the fourth quarter, accounting for 23% of flows. That is the highest quarterly level on record. Now, reading into this, investors may be positioning for a more volatile macro environment in 2025, with a potential opportunity specifically in macro and multi-strategy funds. But then there's also this expected uptick in capital market activity, and that could benefit event-driven hedge fund strategies, which our team has also recently upgraded. Now, the bottom line is this: private credit continues to be the standout, private equity is certainly gaining momentum, and investors are increasingly looking at secular tailwinds in infrastructure. As we head into 2025, investor positioning within alternatives will continue to evolve alongside the shifting macro landscape, and we'll be sure to keep you updated. And that's your one thing in private markets this week. I am pleased to welcome my first guest today, David Stubbs, Managing Director and Investment Strategy Lead at Blackstone Private Wealth Solutions. You may recognize David from his frequent appearances in the financial media, and David has an interesting background with time spent in the United Nations, the British government, and he holds a PhD in economics. David, it's great to see you here in the iCapital studio.
Great to be here, Anastasia.
Lots to talk about, and you've been at Blackstone now for about 2 years, and certainly very entrenched in the macro outlook that you have as a firm. Is it an optimistic note going into 2025, or how are you thinking about the world right now?
Yeah, we are blessed at Blackstone to have a whole range of proprietary data large enough to be macro relevant. So we own more than 250 companies, for example, employ several 100,000 people, have thousands of real estate assets, and you bundle those up, you can get a picture of how the economy is doing. And it is reasonably optimistic. We see solid earnings and revenue growth from our private equity businesses. We see hiring actually starting to pick up. We've seen this significant disinflation over the last couple of years along input costs, wage costs, etc. That's continuing at a slower pace, but it's still continuing. And so, yes, I think optimism is there, but obviously an uncertain environment on the policy front. But overall, I think that we have great optimism about some of those key themes, some of our ability to place capital behind them, and the health of ultimately our assets right now.
Is there anything that concerns you about this largely optimistic message?
You have a very strong US dollar. You have no shortage of geopolitical concerns. But overall, we are absolutely focused, as we always are at Blackstone, long-term thematic investors, focused on things that are going to change in society, placing capital behind them. It's hard to see some of those trends weakening in the short term, so that's why we're quite optimistic.
Alongside that cyclical growth, there's also a lot of sort of underlying thematics that you focus on as well, or megatrends as you call them. So what are some of those and that you're investing alongside, and how can investors benefit?
Yeah, so we have a collection of themes. Some of them come under this moniker of infrastructure of the future, like data centers fueling the AI revolution, the broader digital technology transformation, the energy and power requirements behind all that. And then life sciences as well, a very exciting part of our platform. So if you look at those kind of four themes together, this is really kind of the building blocks of the future of society, right? How we're going to live, how we're going to work, how we're going to power ourselves. And these are really capital intensive transformations that society is undergoing. We're able to supply client capital to them. Around that, I think some other really exciting themes around, say, the strength of the high-end consumer, the experiences they desire. And also we've been focusing on the kind of type of business. For example, we've done some landmark transactions recently where we've taken over a franchise. So we're going to be a franchisor. And that's a great capital-light way, I think, to grow very rapidly in certain segments.
All right, so let's talk a little bit about each sub-asset class that you focus on within Blackstone. Let's start with the big one, the private equity. The thing that strikes me is that everyone seems to be fairly optimistic on private equity for 2025, and especially the exit environment. And we've seen that uptick a little bit towards the end of last year. We saw more M&A and IPOs happening. So what's the outlook for you for private equity exits this year? Do you think we'll deliver against those high expectations?
I think it's important to emphasize that private equity has already come a long way in the last couple of years. If you look at our deployment last year, for example, it was up 70%. Right, so we really wanted to lean into areas of dislocation. We wanted to back those key themes. Fundraising has also been very strong as well. And if you look at our platform, its ability now to provide investors with lots of different styles within one investment. If you look at where the public markets are, valuation is quite elevated at the moment. So we think that investors are going to embrace private equity as a core holding, a complement to that public equity exposure. And we've got a great platform to provide that for investors.
Right. So you mentioned public market valuations, but what do you say about private equity valuations? Are they not elevated relative to the last few years?
It's tough to get direct comps on this, but for example, if you do look at some publicly available sources, you would say that they're not as stretched. I think that's the clearest thing you could say. Ultimately, especially in private markets, the type of private equity we offer really is very different to what would be captured in any type of index, right? So if you look at some of our marquee transactions, they tend to be a very large size, involving large companies. I wouldn't say to draw a conclusion with our starting valuations versus any index at the moment, but we know where the S&P valuations are relative to its history. We know how overweight a lot of private wealth portfolios are in that asset class. I think that's going to be the trigger for people looking for another way to get exposure to equity.
Yeah, well, I think it's a really good point that you can't just look at the index, because you certainly at Blackstone don't just invest in the index, you invest in those individual transactions. But if you do look at the index, right, let's say private equity valuations have increased, but they're still below where the public markets are. And we also look at middle market buyout strategies, and those valuations seem to be quite a bit better. So it sounds like pockets of opportunity for sure within private equity. But let's talk a little bit about private credit, which sort of goes hand in hand with private equity. The question that I get a lot when I speak to clients is, it sounds like a great value proposition, but everybody's talking about it. Everybody has been raising a private credit fund, and therefore, is it oversaturated? What do you say to that?
There's certainly a lot of new entrants in the space, for sure. We believe that private credit is becoming a core asset class. I would say, though, that there's a massive spread of what people are offering, right? If you look at what we're offering, we are unapologetically focused on providing a core, quite defensive exposure built on the largest companies, the most stable economic sectors, being senior in the capital structure, controlling the documentation. I think that is a type of private credit that can really be an all-weather asset class, one that is designed for when times might be a little tougher than what we've seen in the last couple of years. And the economy is growing very fast, defaults are very, very low. That's not the test behind a private credit fund. So I think in all private markets, people should do their due diligence. What is the underlying fund actually investing in? For us, you'll find that high quality, quite defensive exposure. That's not the case with every one of these new funds coming in.
Right. So many participants in the market worry about the Fed not being able to cut rates much more. And, obviously that would have a negative implication, presumably, on parts of private credit that are floating rate. Do you have that concern? Do you think, we see higher defaults if rates don't continue to move down?
I think you might start to see divergence within all these private credit funds. I think that we are well positioned and have literally designed our platform around this notion that we want to be there through cycles, which means you've got to prepare for times when things might get a little tougher.
So let's talk about the other big part of the private markets portfolio, which is infrastructure and real estate. And, the stat that we see on our iCapital platform is that 35% of real asset flows in our most recent quarter actually went into infrastructure assets. And that was 8% in 2022. So what kind of reallocation shift are you seeing at Blackstone in terms of infrastructure and real estate? And where do you think the best opportunity is right now?
Well, we definitely see people embracing our infrastructure platform at Blackstone. I don't think it's a surprise that maybe infrastructure is so hot right now. A couple of reasons. The main planks of our infrastructure strategy are going to be data centers, the energy required for them, and transport. So much of that is in the news right now. Every day brings more headlines around energy. So it's definitely front and center in people's consciousness, both advisors and end clients. I think the second point is very few people have exposure to private infrastructure in their portfolio already, right? There's kind of a gap there. And then lastly, of course, we've just come through a period of elevated inflation. Infrastructure, certainly our infrastructure platform, has a high proportion of assets with inflation protection. So advisors, clients looking for a little bit more inflation protection, they may also reach for the infrastructure lever. It doesn't mean that we are de-emphasizing real estate. I think investors much more familiar with that. We've had obviously large private real estate funds around for a long time now. So I think both of these asset classes kind of a hybrid, both are replacing a portfolio, but no surprise, infrastructure is kind of where people's focus is right now.
All right, David, that was a great kind of roundup of all the different sub-asset classes, but help us put all of that together. If I'm a private wealth client, how do I think about putting all of that into my portfolio?
Well, we're sitting on a show called Beyond the 60/40, Anastasia, so I guess we should use that as a frame. The obvious thing to add private equity into the 60, I think, is a no-brainer. We know where the valuation of public markets are. Adding in some private equity with the multiple allocations to different styles that we discussed, I think is really important. But maybe the most urgent thing is what's going on in the 40, right? There, you've seen a lot of volatility at the long end. The secular decline in bond yields probably over after 40 years there. So what you want is something to be at the front end, or a shorter duration with a credit spread you think is responsible and you can trust it. And then real estate and infrastructure, they're kind of these hybrid asset classes. They've got some growth, they've got absolutely some thematic exposure, but they have a lot of income and inflation protection. Some of that income is tax preferred as well for certain investors. So I think that kind of sits between equity and debt.
Right. Well, David, thank you so much. Thanks for coming by. Thanks for helping us put it all together, how it fits into a private client portfolio. And really thank you for the terrific insights and investment opportunities at Blackstone and bringing them to us. Thank you.
Pleasure.
Today, in our Tech Spotlight segment, we're catching up with Anthony Polemis, Head of Architect Business Development at iCapital, to talk about new exciting features of Architect and just more broadly about portfolio construction. Anthony, thanks so much for coming by again. We've seen you quite a few times actually over the last 12 months, and it's been an exciting journey for Architect, including some of the new features that we'll talk about today. But my first question to you is, for advisors who are building an asset allocation to include alternatives, it could be quite a complex process. So how are we helping streamline that with technology?
Yeah, thanks for having me on. Historically, advisors have used portfolio risk and construction tools for a long time in public markets to build portfolios. And so what we did with Architect is when we released it a year ago, really for the first time, we brought to market a tool that can help advisors bring alternatives into the picture. So advisors can select alternative funds from their iCapital menu, drop them into their public portfolios, and then do a side-by-side comparison. What we've recently rolled out, though, is a couple of new and really exciting features. So for advisors who are maybe a little bit newer to alts allocations and maybe need a little bit of help in terms of where to start, we've introduced sort of two new paths for them. So one feature that we've rolled out is the ability to bring an iCapital model portfolio directly into your public allocation. So our research team has created these outcome-oriented model portfolios, balanced and growth, that with a single click, an advisor can bring into his or her client's public allocation for analysis. The next feature, this is our goals-based portfolio allocator. So an advisor might have an idea of the outcome that they want for their client, but not necessarily know, where to start. And so with this allocator, what an advisor can do is set up their client's objective. Maybe that's hitting a return target. They can set some constraints. Maybe the client doesn't want to sell down from this or that position, or maybe the client has a volatility target they're looking to reach. And on the basis of those goals or constraints, we can then run the allocator, and what that will surface is, options that the advisor can use to meet those objectives and then can fill in with specific funds. So taking all of those three together, we're excited about all the different options that advisors have to build portfolios in Architect.
Right. And this ability to optimize a portfolio based on a set of goals and maybe their specific return goals is really critical because, a lot of advisors, as they go through the financial planning for their clients, they do kind of back into a specific return target that they need to reach. So step one is building the portfolio, incorporating the alts into the portfolio. But step two has got to be, needing ongoing insights to manage that portfolio. So how do we solve for that?
Yeah. So once you put the portfolio together, the next thing that you sort of need to do on your list is think through, is this the right portfolio for my client? So you might want to look at historical returns or volatility levels. Is this alt allocation delivering me, what I'm looking for from a return perspective, from a vol perspective? You might want to look at diversification. So is this portfolio offering, diversifying the risk factors that I want it to? You might also consider things like liquidity. Is introducing these alts in line with my own client's liquidity profile, and does it overall fit their sort of set of preferences? Those are the types of analytics that you might look at, following an analysis in Architect.
And, there are a lot of nuances because some clients might be familiar with alternatives, others are not, and similarly for advisors. So this process of communicating the benefits of alternatives from the advisor to the client, how can technology play a role there as well?
Yeah, so I think you just hit on probably our highest demand feature. So what we've heard from advisors, really all the time is that this is really a big challenge, right? As you said, alts are complicated, they're nuanced, and there really hasn't been, to date, a tool that can help advisors actually put a piece of paper in front of their client that shows holistically the impact that alts can have in an allocation. And that's why we're really, really excited to roll out a client-friendly report from Architect for RIAs that's really designed to help out with that conversation. So now, when an advisor goes to talk to their client, in addition to talking about the fund specifically, they can really paint a much broader picture about the entire allocation and about the outcomes that alts can help drive.
So that conversation really helps the advisor and the client be aligned about what kind of alternative strategy they're going to pursue and how that fits into the overall portfolio. But how do you translate that strategy into action?
Yeah, so you've built your portfolio, you've analyzed it, you've spoken to your client about it. Well, the next step is investing. And so if you've built out an allocation that contains a group of alternative funds, directly from Architect, you can actually kick off a multi-investment workflow and actually go through the process of investing in each of these funds and the next steps, kind of following portfolio construction. So we're really taking it from idea generation all the way through to execution.
Well, Anthony, thank you so much for sharing your perspective on how technology can really help optimize all the various steps of the process of explaining alternatives and embedding alternatives into the portfolio. I know you always focused on building out new features, so congratulations on launching this incredible set of new features, and we'll look out for many more, I'm sure.
Great.
Thanks so much.
Thanks for having me.
Thank you. And we'd like to hear from you. Send us an email at yourquestion@icapitalnetwork.com and let us know what questions are at the top of mind for you and your clients. I'm Anastasia Amoroso, and thank you for joining us today. We'll see you next time on Beyond 60/40.